Most retirees pick their investments first, then they try to figure out the plan afterwards. Smart retirees do the exact opposite. They build the system first, then they choose the funds that fit each piece. Today, I'm going to walk you through the 3-bucket retirement system, and we're going to fill each bucket with specific ETFs, 5 of them. Each one has a job. Each one earns its spot. Now here's where it gets interesting. One of these 5 ETFs returned over 25% in the last year, but it's not the one you'd put the most money into. And by the end of this video, you'll understand exactly why. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Why 3 buckets instead of one big pile? If you're already retired, you know the fear. A bad week in the market and your stomach drops. Not because you lost some number on a screen, because that's your grocery money, your electric bill, your life. The 3-bucket system exists to fix that feeling. Here's how it works in plain English. You take your retirement savings and split them into 3 separate buckets. Each bucket has one job and a different time horizon. Bucket 1 is your foundation, cash. Short-term bonds, 1 to 2 years of spending set aside where you can reach it. When the market drops 20%, you're not selling stocks at a loss. You're pulling from this pile and waiting for things to recover. Bucket 2 is growth. This is where your money fights inflation. CPI ran about 3.5% year over year as of June 2026. If your portfolio isn't growing at least that fast, your buying power shrinks every single year. Bucket 3 is income, your monthly paycheck. ETFs that send you cash every month so you can cover bills, travel, and live without selling a single share. Now, a financial planner named Harold Evensky created the original version of this back in 1985. Christine Benz at Morningstar later built it into the 3-bucket model most people know today. And I want to be honest with you about something. The research says the bucket strategy does not beat a simple rebalanced portfolio on raw returns. A study by Professor Javier Estrada looked at 115 years of data across 21 countries and found that static balanced portfolios outperformed bucket systems on 4 different performance measures. So why use it? Because it works where it matters most, in your head. During the 2022 crash, retirees using the bucket system didn't panic sell. They had their cash reserve. They waited. And that's the real value. Not better returns, better behavior. And for most retirees, better behavior is better returns, because the worst mistake you can make is selling your stocks at the bottom of a downturn. Here's what I mean. Say you panic sold in October 2022. You locked in a loss of roughly 25%. If you stayed in, you'd have been up over 50% by late 2024. That's the difference discipline makes. So now you understand why the buckets exist. But the question is, what goes in each one? Let's start with your foundation. Bucket 1 is your sleep-at-night money. Bucket 1 needs to cover 1 to 2 years of living expenses. For many retirees, that's somewhere around $40,000 to $80,000, depending on your spending. Part of this stays in pure cash, high-yield savings, money market, whatever gives you instant access. The rest goes into BNDI. That's the NEOS Enhanced Income Aggregate Bond ETF. BNDI holds a basket of U.S. aggregate bond funds, but NEOS adds a twist. They sell SPX put option spreads on top. That extra premium pushes the distribution up to 5.8%. Expense ratio is 0.58%, and that's contractually capped through May 2027. Now, let me be straight with you. BNDI is a small fund, about $160 million in total assets, and layering equity index options onto a bond fund is not traditional. You're adding a sliver of stock market risk to what's supposed to be your safest money. So why include it? Because 5.8% is meaningfully more than a plain bond fund paying around 4%. And the NEOS tax structure gives you Section 126 treatment and return of capital on distributions, which means you keep more of every dollar in a taxable account. Think of BNDI as bonds with a bonus, not a savings account. One more thing before I show you Bucket 2. Both Evensky and Benz agree on this. Do not overfund Bucket 1. More than 2 years of cash sitting there starts dragging your overall returns and may not even beat inflation. 1 to 2 years, that's the sweet spot. So you've got your foundation set. Now here's where your money actually starts working. Bucket 2, the growth engine. Bucket 2 has two jobs: fight inflation and grow your portfolio so Bucket 1 and Bucket 3 don't run dry 10 years from now. Two funds go here. First, SCHD, the Schwab U.S. Dividend Equity ETF. SCHD only yields about 3.1% right now. I know, that sounds low compared to what's coming, but SCHD isn't built for today's paycheck, it's built for tomorrow's. Here's why that matters. SCHD's dividend has grown between 7% and 11% per year over the last decade. Let me do the math. Say SCHD pays you $3,100 a year on a $100,000 position today. If dividends grow at even 8% per year, in 5 years that same position is paying you roughly $4,500. In 10 years, about $6,700. You doubled your income without adding a dollar. And the total return backs it up. 1 year total return is running roughly 22 to 24%. Expense ratio is just 0.06%. That's $6 a year on a $10,000 investment. You can't get much cheaper than that. SCHD holds about 103 high-quality companies: Abbott, Amgen, Merck, Coca-Cola. These are businesses with over a decade of dividend history. The quality screen filters out the risky high-yielders that tend to cut their payouts. That's the whole point. Now the second growth fund, QQQI, the NEOS NASDAQ 100 High-Income ETF. QQQI gives you tech exposure: NVIDIA, Apple, Microsoft, Amazon, and runs the NEOS options overlay on top. Distribution rate right now is 14.05%. 1 year total return, 25.70%. That 25% return is where the thumbnail number comes from. It's real. But here's the honest trade-off. The NASDAQ 100 index itself returned about 37% over a similar period, so QQQI captured the income and some of the growth, but gave up roughly 12 percentage points of upside. That's the structural cost of the option strategy. And I need to tell you, QQQI only launched in January 2024. It has never been through a bear market. We don't actually know how it holds up when tech drops 30 or 40%. That's why it sits in the growth bucket as a satellite, not as your core. Good upside, real risk. Keep it sized accordingly. Quick question before we move on. Are you more of a total return person who watches the portfolio grow, or do you prefer seeing cash deposits hit your account every single month? Drop it in the comments. I read every single one. So you've got your foundation in Bucket 1 and your growth engine in Bucket 2. Now let's fill the bucket everybody really wants to talk about. Bucket 3, your monthly paycheck. This is your freedom bucket, the one that actually replaces a paycheck. Two funds here, one core holding and one satellite. The core is SPYI, the NEOS S&P 500 High-Income ETF. SPYI holds the S&P 500 and runs an actively managed call spread overlay on the SPX index. Distribution rate right now sits at about 12%. Actually, let me be precise. The fact sheet says 12.08% current, 12.78% trailing 12 months. 1 year total return is roughly 18.7 to 19%. So you're distributing about 12%, and the fund is still growing by 6 to 7% on top of that, well above inflation. Here's what really sets SPYI apart for retirees in taxable accounts. Because NEOS uses SPX options, the gains get Section 1256 tax treatment. That means 60% of the option gain is taxed at long-term capital gains rates and only 40% at short-term, regardless of how long you held the fund. And it gets better. Roughly 94 to 98% of recent SPYI distributions have been classified as return of capital. ROC is not taxed when you receive it. It lowers your cost basis instead and gets taxed later when you sell. For a retiree spending those distributions and never selling shares, that's a meaningful tax advantage year after year. Now the satellite, JEPI, the JP Morgan Equity Premium Income ETF. Yield is about 8.2%. JEPI is the smooth ride. It picks lower volatility stocks and uses equity-linked notes to generate income. In 2022, when the S&P dropped about 18%, JEPI only fell about 3.5%, real downside protection. But the trade-off is real. In the 2023 and 2024 bull markets, JEPI captured only about 38 to 50% of the S&P's gains. It lags in strong markets. That's by design, but you feel it. And here's the tax piece you need to know. Most of JEPI's distribution is taxed as ordinary income, not qualified dividends, not Section 1256, your full marginal tax rate. So here's the smart placement. SPYI goes in your taxable brokerage account. Let that Section 1256 treatment and ROC do their work where it counts. JEPI goes in your traditional IRA or 401k, where the ordinary income tax hit doesn't matter, because everything in there is taxed the same on withdrawal. That one placement decision, which account holds which fund, could save you thousands over a decade. If someone you care about is building retirement income and hasn't thought about which account holds each fund, share this video with them right now, seriously. So now you filled all three buckets. But what does this actually look like with real money? Let me show you. The $400,000 blueprint. Let's put real numbers on this. Say you're 67. You've got $400,000 to allocate across these 5 funds. Social Security covers your basics. You want this portfolio generating additional monthly income. 3 ways to build it: conservative, moderate, and aggressive. So the conservative build, heavy on bonds and dividend growth. Lower income today at about $2,400 a month, but that SCHD dividend keeps growing, so your income climbs every year. The moderate build, good balance, about $2,940 a month. You're getting income now and growth for later. The aggressive build pushes it to roughly $3,500 a month, but you're loading up on QQQI and SPYI. More options exposure, more volatility, more risk if the market turns. Now, think about what that means. $400,000 generating somewhere between $2,400 and $3,500 every single month, on top of Social Security, without selling a single share. That's the power. Not any one fund, the system. But before you pick a scenario, I need to show you the one number that tells you whether this whole thing is actually working, and most people have never even looked at it. The number that tells you the truth. Here's the myth. A high yield means a high income forever. Here's the truth. Yield is just a snapshot. It tells you what the fund is distributing right now. It says nothing about whether the fund can afford to keep doing it. The number that actually matters? Total return. Let me show you why. JEPI pays about 8.2% in distributions, but over some trailing 12-month periods, its total return has been around 7.4 to 7.8%. When a fund distributes more than it earns, the difference comes from somewhere, your principal. That's called NAV erosion. Your fund balance is quietly shrinking. Right now, SPYI and QQQI are in the clear. SPYI distributes about 12%, and its total return is roughly 19%. QQQI distributes 14% and returns about 25%. Total return is well above the payout. The income is covered by real gains. But, and this is critical, if the market turns or if volatility drops and options premiums shrink, those numbers can flip fast. QQQI has never been tested in a bear market. SPYI has only been around since August 2022. So, here's what I want you to remember. Total return tells you the truth. Yield just tells you a story. Check total return once a quarter. If it drops below the distribution rate for 2 straight quarters, it's time to rethink your allocation. Not panic, just rethink. Adjust the sizing, maybe trim the aggressive fund and add to SCHD or BNDI. That's the beauty of the bucket system. You don't have to tear it down, you just rebalance between the buckets. If someone you care about is building retirement income and hasn't thought about which account holds each fund, share this video with them right now, seriously. So now you've filled all 3 buckets, but my question is, if you had $400,000, which build would you go with? Conservative, moderate, or aggressive? And more importantly, why?
Drop it in the comments. I'm genuinely curious what fits your situation. If you're building income from your investments and want to stay ahead of changes like these, subscribe to this channel and hit that bell so you don't miss the next one.